Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit in current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message. And I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls. I'm broadcasting.
Well, I do have a great team when it comes to developing a financing plan to save you money. I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today. We celebrate every day on Ron Siegel Radio. What is our celebration of this day? Oh, I like this one. This is a good one. National Eat What You Want Day. Now look at those pictures. Does that look like the diet of somebody who's trying to get rid of a bunch of extra baggage? Look at that. Got pizza, French fries. Oh, there is a salad in there. That's a token, it looks like. And a burger, pizza. I don't know. I guess when you eat what you want, that's how I got to be 425 pounds. So maybe that's not quite the idea of what we want to be dealing with. I still love the shots that we take and the journey that we've been on. rsrlinks.com/shot. If you want to check out the journey, it's been a good one for my family and I. Let's take a look and see what the markets are doing today. The Dow Jones Industrial Average down 20.5 points. NASDAQ is up 94. The S&P 500 is up 24. Oil up $2.61 per barrel. Do we like that? No. Ow! What does that mean for gasoline prices? Do we want to see those? Well, you know something? We're in California, so we deal with gasoline prices on a regular basis. $6.16 a gallon is the average for a gallon of gasoline in California. Ow! Yeah, once again, I say the same thing. That is painful. $4.52 is the national average. And Josh is laughing at us over there at just barely above $5 a gallon. And we're sitting here at over $6 a gallon here in the formerly Golden State. And our last tanker of gasoline just arrived. So now what's going to happen when we have less gasoline available than what's been available going right along? But hey, we got Gavin Newsom, so we just figure that it doesn't matter. I did hear that the president is looking or considering putting a freeze on the federal gas tax, 18 cents a gallon. It would not surprise me. Now, I'm not going to say that he's going to do this. I won't say that he won't do it, but it would not surprise me if there was some sort of a matching incentive. So instead of just saying, we're gonna freeze the gas tax or we're going to put a moratorium on the federal gas tax, well, we'll do that as long as the states match the amount. Think that'll happen? Don't know. Wouldn't surprise me, and I think it would be a good idea, but who am I? I'm just doing a little radio show here in Southern California on ABC News and Talk. So we watch and see what else is going on there. We've got, am I the only one that's getting a little bit blasé, I guess would be the word, of the daily discussions of what's going on in Iran? Right? I mean, you look at it and you say, okay, we've got a peace talk going on. We don't have a peace talk going on. The president puts forth a solution. They reject it. They put forth a solution. We reject it. And on and on and on it goes. And it's really, it means nothing. And you kind of, it's like the boy who cried wolf, right? I mean, it's on one day, off one day, and nothing tends to happen except gas prices go up, gas prices go down. We're going to see a CPI inflation report tomorrow. That's going to show us that inflation is continuing high. Now, do we need an inflation report to tell us that? They're just going to tell us numbers that are fake. And why do I say they're fake? Because they haven't changed the methodology of collecting them in 40 years. So the numbers are all old numbers. If we were to ever get some real numbers, some current numbers, like we could get real simple, all you have to do is go to Trueflation, and they track the real-time numbers that for some reason the government is too old and stale to figure those things out. So if they ever figured out how to just use the Trueflation numbers, it's amazing how many numbers we get from the Bureau of Labor Statistics that are old, outdated, stale numbers, yet we continue to get the same numbers, and those are the numbers that move the markets. What do I mean by that? Well, we get the death rate model that gives us bad numbers from the Bureau of Labor Statistics. If you follow our weekend update, and we put that out every Friday afternoon, rsrlinks.com/weekend update. You can get our thoughts on the market for the weekend. And we put that out for the professional community. And I don't mean that in a derogatory way. We send that out to financial advisors. We send it out to insurance advisors, real estate professionals. Every Friday afternoon, there's a subscription of about 8,400 that get this letter. And it is a presentation of what goes on in the market. And we went over exactly what the old data is showing on the jobs report and why it's become irrelevant. It used to be that the first Friday of the month, we got the jobs report. And I know the first Friday was the 1st of May. So it actually came out on the 8th of May this month. But it's generally the first Friday of May, we get the jobs report. And it used to be that it moved the market tremendously. This time, there was a major, major beat. The jobs report came out. Their expectation was for 60,000 new jobs, came out like 105, 110,000 new jobs, and it didn't move the market. So why is that? Well, the market is smarter than the government, and being that the government won't change, the market's basically saying, we're going to discount anything you say. We don't care. And the market didn't move like it normally would because the data is always old, and they go back and they revise the data so much. It's not like just minor tweaks in the data. It's major revisions, and we saw that again this time. So the markets basically say, okay, you're wrong. You're going to give us wrong data, so we're not going to trade on it. We're going to use something different. Well, we're going to get the CPI report, and I think that comes out tomorrow. And it once again comes out from the Bureau of Labor Statistics. And we're going to see that they're using old, stale data. And a company like Trueflation has real data. The markets are going to move based on what they see legitimately, as opposed to what they're seeing from something like the Bureau of Labor Statistics. We'll talk more about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. Veterans are leaving $13,000 on the closing table. Here's how to stop it. On a $650,000 mortgage, the wrong strategy costs you a second home before your kids graduate. Most people track their portfolio. Almost nobody tracks the three numbers that matter more. Why staging your house could pay off this spring, and could co-buying be the answer for some first-time buyers? All that and more. Reach me anytime. Off-air number 800-306-1990. 800-306-1990 or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Mortgage Minute today being brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. I think that's, are you hearing me, Josh? No hearing me. Can you hear me now? Hello? Did you hear that? Are you hearing us? Okay. Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app, and every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions. Nationwide, they don't tell us points paid, points received, or the APR. They tell us the number you put in your mortgage calculator to determine your principal and interest payment. If you don't have a mortgage calculator, we've got about 70 different illustrators, financial illustrators, rsrlinks.com/calculator, rsrlinks.com/calculators. So what did rates do on Friday? Conventional 30-year fixed, flat 6.328. Jumbo 30-year fixed, 6.506. That was down. FHA 30-year fixed, 6.129. That was up. VA 30-year fixed, 5.903. That was down. And the USDA 30-year fixed, 5.99. That one was up. And if you want our thoughts about the market, join the Ron Siegel Radio community, rsrlinks.com/HBOD, rsrlinks.com/HBOD. Let's see what the markets are doing today. The S&P 500 is up 24.5 points. The 10-year Treasury is up 4 basis points, 4.39. And the mortgage bond is down 25 basis points, par 56 right now. Remember, bond down, rates up. That's just the way the math works. It's not an opinion. It's straight mathematics. What's driving it? Well, oil prices and yields a bit higher this morning on news that President Trump said Iran's reply to the one-page peace memorandum was unacceptable. As a result, the Strait of Hormuz remains effectively closed. There were 3 main points that were deal breakers. Iran wanted reparations from damages done during the conflict. Oh.
You know better than that.
Let's see. They wanted to remain in control over the Strait of Hormuz and to push back talks on nuclear enrichment past the initial framework. It does not appear that Iran is serious about a peace deal, but the markets are surprisingly hanging in there. The U.S. is producing and exporting so much oil, but prices are still going up here. Why? California just received their last oil tanker shipment from the Middle East, which is very important because they import 1/3 of their oil. That's based, remember, this is a national report. So we got 1/3 of our oil from the Middle East. Why not Texas? There's a natural impediment from the Rocky Mountains, so it's difficult for oil to make its way to California and prevents pipeline construction from going across. But all oil is not the same. California is accustomed to receiving imported heavy sour oil Texas produces light sweet crude, which most of our refineries are not set up to refine into gasoline. Most of U.S. refineries are set up to receive heavy sour, which is why we need to import so much oil. Venezuela could help as they produce heavy sour crude, but it will likely not cause oil prices to come down. Oil prices are determined by worldwide supply and demand rather than local production levels. If a conflict or shortage happens anywhere in the world, prices rise everywhere. For example, Europe doesn't produce their own oil at all. They bid prices higher. Oil companies and fuel wholesalers are private entities that maximize, and their goal is to make money, selling on the open market rather than at a discount domestically. They sell to the highest bidder, which sets the price. Tomorrow we got the CPI inflation report, which will be important and likely not friendly due to the rise in oil prices. Headline CPI is expected to come in somewhere between 0.5% and 0.6%, replacing a very low figure from last year. The year-over-year reading is expected to rise from 3.3 to 3.6 or 3.7. We believe it will come in around 3.7. This will likely not be friendly to the bond market. Core reading, which strips out food and energy, is expected to rise by 0.2% to 0.4%, which would cause the year-over-year figure to remain either at 2.6 or 2.7. Existing home sales were released this morning, showing that closings on existing homes in April rose by 0.2% to an annualized pace of 4.02 million. There was a positive revision to March. From the originally reported figures, sales were up 1% in April. Sales are now flat year over year. Existing inventory rose 5.8% to 1.47 million units, which is normal for this time of year, but still remains relatively tight. Based on the pace of sales, this month's supply of inventory is 4.4 months, still below the balanced market of 4.6. The median home price rose 2.1% last month and roughly 1% year over year to $417,700. Remember, that's median price. That's the mix of sales. Does not mean a thing about property appreciation or moderation in your neighborhood. The National Association of Realtors released their Realtor Confidence Index within this report, showing that homes remained on the market 32 days, down from 41 days in the prior month, but up from 29 days this time last year. 21% of homes sold above the listing price, up from 18% last year. First-time buyers accounted for 33% of sales, down from 34% last year, while cash buyers made up 25% of transactions, unchanged from this time last year. Investors accounted for 16%, which was up from 15% last year. ICE reported that home values rose 0.32% in April on a seasonally adjusted basis, which is the strongest gain in home prices that they have reported in 2 years. It shows a bit of resilience and momentum heading into the spring home buying season. Year over year, home values are up about 1%. That is the Mortgage Minute. Brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. Let's see. Mortgage 101 brought to you by rsrlinks.com/keysteps, rsrlinks.com/keysteps. And this is about our favorite group of people. Yes, that would be our veterans. If you are a veteran buying a home right now, there's a good chance you're leaving thousands of dollars on the closing table, not because of your rate, not because of your credit, because of one line in your purchase contract that nobody bothered to write the right way. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today we're talking about one of the most misunderstood, most underused advantages in the entire mortgage world. VA seller concessions, and one detail buried in the VA lender's handbook that almost nobody is using correctly, but we're going to tell you about it. Here's the truth. Most loan officers think they understand this. Most real estate agents think they understand this. And every day, veteran buyers lose deals or write checks they shouldn't be writing because the people guiding them are blending two completely separate things into one. So let's clear it up right away. When a veteran writes an offer using their VA loan, There are two different buckets the seller can contribute to. Two, not one. Bucket one is seller paid closing costs, title fees, appraisal, recording, lender fees, buyer agent commission, and here's the part that surprises people, normal market discount points. The VA does not cap this bucket at all. There is no limit on how much a seller can contribute towards standard closing costs for a VA buyer. Bucket two is seller concessions. This bucket is capped at 4% of the home's VA reasonable value, the number on the VA appraisal called the Notice of Value, NOV. This bucket covers the VA funding fee, prepaid taxes and insurance, temporary buy-downs, debt payoff, discount points above market norms. Two buckets, two different rules. Now here's where the strategy gets really interesting. The VA Lender's Handbook, Chapter 8, draws a sharp line between a permanent buy-down and a temporary buy-down. A temporary buy-down, like a 2-1 or 3-2-1, where the rate steps up over the first few years, that always lands inside the 4% concession bucket. It eats up your cap. But a permanent buy-down, a real life-of-loan rate reduction using normal market discount points, that is treated as as a standard closing cost. It is not a concession. It does not touch your 4% cap. A seller can pay for a permanent rate reduction for the entire life of the loan, and it does not count against the 4% concession bucket. A permanent rate reduction for the life of the loan, that is bucket one territory, and bucket one is unlimited. This is why I rarely recommend a temporary buy down. There are times and places where a 2-1 makes sense. A borrower with a confirmed income jump coming, a specific scenario where the deal will not work any other way. But in most cases, a 2-1 buy down gives you 1 or 2 years of relief, and then the payment jumps. A permanent buy down gives you 30 years of savings, and on a VA loan, the seller can pay for it without sacrificing a single dollar of the 4% concession. So what does this mean for you? Let's run real number. A veteran buys a home for $330,000. The VA appraisal comes in at $330,000. 4% of that is $13,200. That's the concession bucket. Written correctly, the contract says the seller pays all of the buyer's closing costs. Title I appraisal, lender fees, that's bucket one, unlimited. Then the seller also pays for a permanent rate buy down using normal market discount points, still bucket one. Still unlimited. Then on top of all of that, the seller gives $13,200 in concessions. That's bucket two, used to cover the funding fee, prepay the property taxes, prepay the insurance, and pay off a credit card balance to lower the veteran's debt to income ratio. The result, the veteran walks into the home with almost nothing out of pocket and a permanent rate that's lower than what's posted on the rate sheet today for 30 years. Written wrong, the same veteran is bringing $8,000, $9,000, $10,000 to the closing table they never had to bring and paying a higher rate every month for the next 3 decades. This is what suitability looks like. Eligibility just means a veteran qualifies for the loan. Suitability means we structured it the right way for their life and their wallet. That's the difference. That's what a certified liability advisor does. Here's the playbook. Step 1. Max out seller paid closing costs first. Step 2, layer in a permanent rate buy down using normal market discount points, still uncapped. Step 3, use the full 4% concession bucket on funding fee, prepaids, and debt payoff. Step 4, make sure the contract clearly separates the buckets so understanding and the listing side both understand what we're agreeing to. Realtors and listing agents listening right now, when you get a VA offer, do not panic. Do not assume your seller is giving up 4% of the sale price. The closing cost portion is normal. Routine. The 4% concession portion is where strategy happens. A clean, well-structured VA offer often nets your seller the same or better than a conventional offer because the veteran is bringing a stronger government-backed loan that's going to close. Veteran, here's the bottom line. The VA loan is not restrictive. It is one of the most strategically powerful loan programs in the country, but only if the people around you actually know how to use it. If your loan officer can't explain the difference between bucket 1 and bucket 2 in 2 minutes flat, you have the wrong loan officer. If your loan officer leads with a temporary buy down when a permanent buy down is on the table, you have the wrong loan officer. If your agent is not separating closing costs from concessions in your offer is weaker than it needs to be. You earn this benefit. Let's structure it like the powerful tool it actually is. Go to rsrlinks.com/VA loan. That's rsrlinks.com/VA loan. We'll walk you through your purchase, show you the 2-bucket strategy in writing, and help you and your agent build an offer that actually wins. Whether you're house hunting today or planning for next year, this is the conversation that puts thousands of dollars back in your pocket and a lower rate on your loan for 30 years. rsrlinks.com/VA loan. It's rsrlinks.com/VA loan. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to Mortgage 101, brought to you by rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, could co-buying be the answer for some first-time buyers? And on a $650,000 mortgage, the wrong strategy costs you a second home before your kids graduate. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Could co-buying be the answer for some first-time buyers? For a lot of would-be first-time buyers, affordability is the thing that's standing in the way. But some buyers are getting creative and finding a way to still make the numbers work, and that's through co-buying. The dream is still alive. The math just isn't working for everyone. Young people haven't given up on the dream of owning a home, not even close. According to First Home IQ, home ownership still ranks among the top life goals for the next generation. The problem? 73% of Gen Z and millennial buyers cite affordability as a reason for not making home ownership a priority. And it shows. First-time buyers now make up just 21% of all home purchases, the lowest share since the National Association of Realtors, NAR, started tracking the data in 1981. But still, some buyers are making it happen, and a portion of them are turning to co-buying to get their foot in the door. So what's co-buying? Co-buying means purchasing a home with someone else, like a friend, sibling, or unmarried partner. You combine income, split the down payment, and share monthly costs. For some people, it's a creative way to turn someday into a concrete move-in date that's just around the corner. And it's catching on. Just look at where things stand today. According to cobuy.io, 64 million Americans now co-own a home with someone they're not married to. In fact, 31.5% of home purchases involve co-buyers. If you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490, FM 98.1 video feed, you are seeing the chart going back to 2021. Nearly 1 in 3 home purchases now involve co-buyers up from 25%. Why it works? Here are just a few of the top reasons buyers are going this route. According to NerdWallet, quicker path to home ownership. If owning a home is a serious goal for you, buying with someone else can help make that reality on a shorter timeline. 2 or more people can save up a down payment a lot faster than one. That's less time waiting and more time building equity in a place that's yours. More purchasing power. With multiple incomes going toward the home purchase, you might be able to afford a nicer home or live in a more popular neighborhood. Sometimes teaming up means getting the home you actually want, not just the one you can barely afford on your own. Easier loan qualification. Added income from more than one buyer can also help with your debt to income ratio, which the lender will calculate based on all the borrowers. Lower housing costs, splitting up a mortgage payment multiple ways could maybe even make owning less expensive than renting. Plus, sharing costs can make repairs or even renovations more manageable too. Things to keep in mind if you're considering going this route. There are some things you'll want to think over. For starters, co-buying works best with people you trust and share financial goals with. So before moving forward, make sure everyone agrees on how costs are split, who handles what, and what happens if one person wants to sell down the road. That's why a written co-ownership agreement can be a smart move. It keeps everyone on the same page and helps avoid headaches down the line. Think of it less like a legal formality and more like a game plan for your new investment. Bottom line, affordability challenges are real, but they don't have to mean waiting indefinitely. Co-buying is helping some first-time buyers stop waiting and start putting down roots. If you're curious whether it could work for your situation, let's talk. Reach out today and let's figure out your path to home ownership. That is the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com. Borrow Smart segment today being brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. On a $650,000 mortgage, the wrong strategy in this economy will cost you the price of a second home before your kids graduate, and the rate on your loan has almost nothing to do with it. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Here's what I mean. Inflation has been a problem in this country for 5 years now, and the latest economic forecast out of Washington this week is telling investors we're not going back to normal anytime soon. They're calling for 3% inflation through the end of this year and 4% if oil stays right where it is now. From 1992 to 2019, inflation averaged 2.2% a year. That's the world your monthly budget was built for. We do not live in that world anymore. To see how bad this really is, you have to go back to 1960s and 1970s. During the Vietnam War, we had 2 years in a row of 6% inflation. Then came the OPEC oil shocks, and inflation averaged 9.5% a year for almost 9 years. People who lived through that remember it. People who did not are living through their own version right now. What is driving the latest jump? The war in Iran. Aluminum prices in the United States are up almost 90% in 1 year. Tariffs went from 10% to 50%. That hits everything from your car to a can of soda. Fertilizers up 23% since February. By one estimate, 70% of American farmers cannot afford the fertilizer they need this year. That's your grocery bill in 6 months. Gas is up, cars are up, insurance is up. And the 10-year Treasury, the number that moves mortgage rates, is rising slowly until the war ends. So if you're sitting on the sidelines waiting for rates to drop, you may be waiting a long time, and while you wait, prices keep climbing. So what does this mean for you? Sitting at your kitchen table looking at a $650,000 mortgage? It means strategy beats rate, always. And in an inflationary economy, it is not even close. Let me show you how this works. Most homeowners chase one number, the interest rate on the mortgage. That is the wrong target. The right target is your household blended interest rate. That's the weighted average of every dollar you owe. The $650,000 mortgage at 6.25%, The credit starts sitting at 24%. The car loans at 9%, the HELOC at 10%. Add them all together, weight them by balance, and you get the real number. That is the rate that actually eats your paycheck every single month. Here's a generic example. A family I worked with last quarter, $650,000 mortgage, about $100,000 in other debt across 2 credit cards, 2 car loans, and a home equity line of credit. On paper, the mortgage rate looked fine at 6.25%. But once we blended in everything else, their household rate was almost 11%. 11% on $750,000 in debt. They were losing the inflation race before they ever got out of bed. So here's the strategy we walked them through. I call it the 2-step. Before I lay it out, I need to be clear. This is not an offer. This is not a rate quote. Your actual rate will depend on your credit, equity, property, and lender, and not everyone qualifies. This is a strategy. rsrlinks.com/2step, rsrlinks.com/2step. Step 1, refinance the entire debt service, not just the mortgage. We wrap the mortgage, credit cards, car loans, the HELOC, all of it into one structure that uses the equity in the home as a working tool, not a trophy on a shelf. Step 2, lower the total monthly debt service because the blended rate drops the monthly outflow, drops with it. In this family's case, they freed up almost $2,000 a month in cash flow. Same income, same house, different strategy. Step 3, take some of that monthly savings, put it back against the mortgage and accelerated pace. Not all of it. That's the mistake most people make. They slam every spare dollar into the house and lock up their liquidity. We take a meaningful chunk and apply it to the principal over time. That compounds in your favor while inflation quietly eats away at what is left of the balance. Step 4, this is the second part of the 2-step, but it's step 4 in this particular scenario. When rates come down again, at some point they will, we restructure with a no-cost loan. No closing costs, no points, no fees rolled in. You ride the rate curve down every time the market gives you the chance. You do not have to time the market. You do not have to time the market because you reset the strategy each time the market resets for you. That's the 2-step. Restructure now, restructure again with a no-cost refinance the whole picture, reset again later when the market opens the door. And here's the part most people miss. Inflation is actually good for fixed-rate borrowers in one specific way. The dollar you owe today is worth more than the dollar you'll pay back in 5 years. Inflation eats your debt for you, but only if you do not panic and pay it off too fast. The instinct in a scary economy is to throw everything at the mortgage and call yourself responsible. That instinct is wrong. You just locked your cash inside the walls of your house, and now you have nothing on hand when the next surprise shows up. Eligibility is what every other lender talks about. Suitability is what we talk about. The difference in this economy is your retirement. If you want to see the 2-step strategy laid out in full, again, rsrlinks.com/2step. That's rsrlinks.com/2step. And when you're ready to run your own numbers with me on Zoom, go to bookrs15.com. That is bookrs15.com. 15 minutes, no charge, no sales pitch, no in-person meeting required. We'll look at your real numbers, your real blended rate, and your real next move. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment brought to you by rsrwealthbuilder.com. That's rsrwealthbuilder.com. You are listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, most people track their portfolio. Almost nobody tracks the 3 numbers that matter most. Why staging your house could pay off this spring. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know
know a homeowner experiencing divorce? Do you know a real estate reference in the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Borrow Smart segment today being brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. Best month for stock market in 5 years. The NASDAQ's up over 15%, the S&P 500 up more than 10%, the Dow added another 7%. So why does it feel like the housing market is heading in the opposite direction? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. The April numbers tell two very different stories. On one hand, the stocks went on a tear. The NASDAQ just posted its best 13-day winning streak since 1992. 84% of S&P 500 companies are beating earnings estimates. Investors are smiling. On the other hand, existing home sales fell 3.6% in March. That's a 9-month low. Building permits, which tell us how much new construction is coming, dropped 10.8% in a single month. They are down 7.4% from a year ago. Builders are pulling back. Buyers are nervous, and the median existing home price barely moved, sitting at $408,800. That is only 1.4% higher than a year ago. So what do we do with that? If you only watch the stock market, you might think everything is fine. If you only watch the housing market, you might think we're in trouble. But here is what I've learned in over 4 decades in the mortgage and finance world. You cannot make good decisions based on either of those alone. You have to know your numbers. Let me give you an example. I sat down with a couple on Zoom last week. They had a $650,000 mortgage at 6.75%. 2 car loans, a line of credit, and some credit card debt they were rolling each month. They looked at their stock account, which had a great April, and they felt rich. But when we calculated the household blended interest rate, the actual rate they were paying across all their debt, it was over 9%. Their portfolio was making them feel wealthy. Their debt structure was quietly making them poor. Their portfolio was making them feel wealthy. Their debt structure was quietly making them poor. Did you hear that? This is why strategy beats rate always. A great month on Wall Street does not change your monthly cash flow. A 2.7% core inflation reading does not change what you owe. And the Fed deciding to hold rates steady at 3.5 to 3.75% does not change the fact that most American families have never sat down and looked at the 3 numbers that matter more than anything Wall Street did last month. Number 1, what is your credit score? Not what was it 2 years ago. What is it doing today, and which direction is it moving? rsrlinks.com/FICO. rsrlinks.com/FICO. Number 2, what is your monthly budget actually doing? Not what you think you spend, what the numbers show. rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. Number 3, what are your assets and your blended interest rate working? What are your assets? And is your blended interest rate working for you or against you? I bring this up the week after Mother's Day because Americans were expected to spend $34.1 billion on Mother's Day this year. $6.8 billion on jewelry alone, $6.3 billion on brunch and dinner. And listen, I'm all for celebrating mom. I did. But the strongest financial move you can make for your family is not a velvet box. It's a clear picture of where your money is going. Here's the thing about a strong market. It's a great time to look honestly at your finances because the noise dies down. Fear is not pushing you. Panic is not pushing you. You can think clearly, and in a year where housing is cooling Inflation is sticky and the Fed is sitting on its hands. Clear thinking is your edge. That's why I offer rsrlinks.com/keysteps. rsrlinks.com/keysteps. It's not a fancy calculator. It's a clean place to track your credit, your budget, and your assets in one spot. So when you have a conversation with me or your CPA, financial planner, or you walk in with the actual numbers, not guesses, not feelings, numbers. Because here's the truth. Eligibility tells you what a lender will let you do. Suitability tells you what is actually right for you. And the only way to know what is right for you is to know your numbers first. Head over to rsrlinks.com/keysteps. Set up your credit monitoring, log your budget, and track your assets. It is free, it is simple, and it will give you a clear picture in 15 minutes than most people have had in 15 years. It's rsrlinks.com/keysteps. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by rsrwealthbuilder.com. That's rsrwealthbuilder.com. Real-time real estate segment today being brought to you by rsrmoney.com. Why staging your house could pay off this spring. Selling your house this season, you've probably heard you should stage it before it hits the market. But what does that really mean? And is it worth the effort? The short answer is yes, especially right now. With more houses for sale this year, you're likely wondering how to make the most money possible without your house sitting on the market. The answer is staging. It can help your house stand out, bring in stronger offers, and sell faster. As Nadia Evangelo, principal economist in the National Association of Realtors, puts it, quote, staging matters. Preparing the home to be buyer ready attracts more buyers, especially now that inventory has increased. Here's what staging actually involves and what it could do for your sale. So what is staging? Home staging is a process of preparing your house so it appeals to as many buyers as possible. That usually means decluttering, deep cleaning, rearranging furniture, and adding simple touches that help each room feel bright, open, and welcoming. The goal is to help buyers fall in love with the space and picture themselves living there, which makes them more likely to make an offer. Why staging is worth the effort. Stage houses tend to perform better on almost every metric that matters when you sell. According to Redfin, staged homes have been shown to sell up to 73% faster than unstaged homes, and they often close in under a month compared to anywhere from 2 to 3 months for vacant ones. There's also a strong return on the money you spend. The Home Staging Institute says mid-level staging can deliver a 350% return on investment. On a $400,000 home, that turns a typical $4,000 cost into $18,000 in added value when you sell. And if you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490 FM 98.1 video feed, you are seeing a chart of the impact staging can have on your house. By that estimate, that's an extra potential profit of about $14,000, a meaningful boost when you're trying to maximize what you walk away with at closing. In case you're seeing that $4,000 upfront investment above and thinking, I'm not going to spend that, here's what you should know. Staging doesn't always have to mean hiring a full crew or filling your house with rented furniture. There are a few different paths you can take depending upon your budget and timeline. So you could spend a lot less and still get a good return. Here are a few options. Professional staging. A stager handles everything from layout to decor, often bringing in their own inventory. According to the Home Staging Institute, costs typically range from $500 to $5,000 or more, depending on the size of your house. Virtual staging. Digital furniture and styling are added to your listing photos, which can be budget-friendly option for vacant houses. DIY staging. If your budget is tight and your home only needs minor updates, decluttering, deep cleaning, and rearranging furniture for flow can still make a real difference. Your agent can help you figure out which approach fits your house, your market, and your goals. Agents see what buyers respond to in open houses and showings every week, so they can give you specific personalized recommendations on what's worth your time and money and what isn't. That way you can get the most bang for your buck, no matter your budget. And if you want our tools on how to sell your house faster and for more money? rsrlinks.com/salesmax. That's rsrlinks.com/salesmax. Bottom line, with more homes for sale right now, making a strong first impression matters. Staging can help your house sell faster and for more, and there's an option for almost every budget. If you're getting ready to list, let's talk about what level of staging makes sense for you and for your house, and make a plan for attracting the right buyers. That is the Real-Time Real Estate segment, brought to you by rsrmoney.com, rsrmoney.com. And as always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. Big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.